Welcome to this Executive Advisory Explainer, where we're going to dismantle a pretty catastrophic architectural misunderstanding about international trade. Look, if you're scaling a commercial enterprise, eventually you're going to outgrow your domestic supply chain. You need better margins, maybe advanced industrial machinery, or you just need to diversify your retail inventory. So naturally, you look across borders. But here is the critical issue. Crossing the international customs border introduces a severe fiscal stress test. And failing to understand this test, it can literally bankrupt an expansion strategy before the cargo even arrives.
You know, a lot of founders scaling internationally fall into this trap. They falsely believe their domestic tax exemptions will protect them at the border. They think, hey, I'm on a simplified domestic plan, I'm safe. But we're going to explore how that assumption actually destroys profit margins. It's a total illusion. In international trade, the customs authority doesn't care about your local tax breaks. To them, it's an absolute tollgate.
So here's our route for today. First, we'll look at the customs tollgate. Second, the STR Import Trap. Third, the General Regime Offset Shield. And finally, executing all of this flawlessly at scale using Odoo Landed Costs. Let's dive in.
All right, Section 1, the customs tollgate, the unavoidable barrier. We really have to begin our analysis right at the physical and fiscal border, because as I mentioned, that's where your domestic tax rules simply cease to exist. The fundamental rule of international supply chain architecture in Central Asia is that customs applies a mandatory 14% tax. And listen, this applies regardless of your domestic corporate size or your registration. Whether you're an unregistered microbusiness, an individual entrepreneur, or a massive corporate LLC, that 14% is waiting for you. The customs authority absolutely will not release your commercial cargo until this percentage is physically paid into the state treasury. We call this unavoidable toll Import VAT. Now, what's really fascinating is how that 14% is actually calculated. It's not just based on the invoice you paid this supplier, it is a strict fiscal stress test based on the full customs value. That means the cost of the goods, plus the insurance, plus the freight, often abbreviated as CIF, plus any applicable customs duties and excise taxes. All of that is bundled together, and 14% of that total must be paid directly to the government before your goods can move an inch further. So the critical difference in your business strategy isn't how to avoid this, because you literally can't. It's entirely about what happens to that capital after the cargo clears customs.
Which brings us to Section 2, the STR Import Trap. VAT as a sunk cost.
Operating under the wrong tax structure builds a massive liability. If an enterprise attempts to execute international imports while operating under the Simplified Tax Regime, or STR, they fall straight into a trap. See, because an STR entity isn't a registered VAT payer domestically, they completely lack the statutory accounting infrastructure to ever recover this capital. They literally do not possess a VAT receivable account on their books. So when they pay that mandatory 14% of the border, that capital is permanently lost. It instantly becomes a sunk cost. And this brilliantly illustrates the real mathematical impact of that sunk cost. Say an STR importer buys $100,000 in base inventory abroad. At the border, they are forced to pay that $14,000 import VAT. Because they can't recover it, that $14,000 is forced directly into their cost of goods sold. Suddenly, they're operating with an artificially inflated baseline of $114,000. The commercial consequences of this? They are absolutely devastating to your scalability. Your cost of goods sold is artificially inflated, so to maintain any kind of operating margin, you are forced to raise your wholesale prices. But it gets worse. When you try to sell those overpriced goods to a domestic enterprise buyer, you're hit with a double penalty. Because you are on the simplified regime, you cannot issue a domestic input VAT credit to your B2B buyers. You essentially brand yourself as a toxic counterparty in the B2B space. You're too expensive, and you offer zero tax benefits to your corporate clients. Not a great look.
So how do we fix it? Section 3, General Regime Offset Shield. Import VAT as a liquid asset.
To actually secure those margins and grow your business, you must transition your architecture. It completely changes the financial mechanics of importing. Let's compare these two supply chain paths side by side to really drive this home. On Path A, our simplified regime importer watches that 14% get absorbed into the COGS, creating a nasty sunk cost and completely destroying their margin. But check out Path B. For a professional financial architect operating under the general VAT regime, paying import VAT is not a sunk expense at all. It is just a temporary cash flow event. The general regime importer logs that VAT right to account 1310 as a receivable asset. They totally protect their margin and offset the cost against domestic sales.
Under this fiscal shield, the paperwork itself actually becomes a highly valuable asset. When you pay that 14% at customs, you get a customs declaration document, and this document acts as your ultimate electronic fiscal invoice. The tax you just paid at the border is immediately posted to your input VAT receivable ledger. Then, the real magic happens: total revenue neutrality. When you sell those goods in the domestic market, you collect output VAT from your customers. You simply deduct the import VAT you paid at the border from your domestic sales tax liability. Bam! It's a 100% border tax recovery. Your COGS stays completely pristine, allowing you to ruthlessly outprice your STR competitors.
Now for the execution. Section 4. Mastering Odoo Landed Costs. Precision execution at scale. Understanding the theory of the general regime is honestly only half the battle. Handling these international shipments requires absolute precision in separating your unrecoverable logistics costs from your recoverable tax assets. Listen, if you try to manage this complex supply chain on spreadsheets, I can almost guarantee you will fail and give your accountant a heart attack in the process. You will inevitably accidentally bury your recoverable import VAT straight into your inventory valuations, losing that capital forever, exactly like an STR importer would. Human error and spreadsheets just cannot handle this level of fiscal routing.
So the crucial point here is how an enterprise resource planning system, specifically Odoo's landed costs module, flawlessly separates these streams automatically. It's a brilliant three-step dance. First, when the customs broker invoice arrives, Odoo lets you allocate the strictly non-recoverable expenses, things like freight and insurance, capitalizing them to mathematically adjust the true unit price of your inventory. Second, it intercepts that 14% import VAT line item, deliberately preventing it from touching your inventory valuation. And third, it routes that exact VAT amount straight to your balance sheet in the VAT clearing account 1310, ready to be automatically offset against your sales.
Integrating this 100% transparent, audit-proof architecture isn't just about good bookkeeping. It is quite literally your ticket to the major leagues of enterprise expansion. By using systems like Odoo to automate this offset shield, a C-level executive completely unlocks the borders, fiercely protecting the corporate margin while aggressively scaling the business. So I want to leave you with this final, absolutely critical thought today. As you sit down to plan your international supply chain, ask yourself, are you going to allow outdated domestic tax strategies to destroy your margins and label you a toxic B2B counterparty? Or will you voluntarily register for the general regime, perfectly leverage the mechanics of import VAT, and build an automated architecture designed to completely dominate the market? The choice of how you navigate the customs tollgate is entirely yours. Thanks for joining me on this explainer, and I'll catch you next time.